Hi, everyone. Welcome, welcome, welcome. We are so excited to have Douglas Dowell here today. He's a brilliant attorney. He has multi-talents. I just found out, it's always fun to know something about somebody that you didn't know before. Actually, it's a game I play, is tell me something I don't know about you. And he has I don't know if it's a dream for the future or if it's a dream that's not going to happen or exactly where, but he always wanted to be a representative of our country in Congress. So that's totally cool. And today, our great Douglas is going to talk about risk and different ways you look at risk and what is the risk and what is important about looking at that risk. So thank you very much for coming, Douglas. We always enjoy all the conversations we have. So take it away.
Well, Peggy, thank you so much, guys. It is an honor to be here yet again to share a different aspect of everything. I'm going to go ahead and share my screen here to do my presentation here. 1 second here. Get to the presentation. And okay, can you guys see that okay?
Yes.
Okay.
I can't say it, but I can see it.
Yeah, that's where we'll start from, guys. We're going to do something a little bit more than risk today. We're going to talk about asymmetric risk, and it's a very fancy term. I'm going to unpack that a little bit for you and go into what we mean by that and how we can use this to change our mindset. Because after all, most of all investing is in one way, shape, or another a successful mindset. And so in terms of what we're trying to do, we're trying to find asymmetric risk as opposed to just risk. And we're going to talk about that a little bit to how it can improve your results overall in investing. And so first of all, we'll start with the definition. And so essentially, asymmetric risk is a situation where the potential upside or downside of the investment are not equally balanced. So an even bet is one where your outcome, or your risk of loss or risk of gain is pretty much around the same amount. Asymmetric risk is what we're trying to find. We're trying to find bets where you bet a certain amount and then you have a much higher upside, and then hopefully just a really minor downside is essentially what we're looking for. For example, if you take a stock investment that goes up 50%, but only if it goes up, it'll go up 50%, but if it goes down, only like 10%. So that's what we're looking for, is where the upside is really, really well stacked in its favor, and then the downside is minimal. And so it essentially looks like this on a graph. You're looking for putting situation where you have small risk, your risk amount versus your reward. Essentially, we're trying to balance that. And so a lot of times, and one of the problems that I think that exists is this is a very it takes a long time. I mean, I took finance in undergrad and ton of finance, ton of econ, and frankly, the statistics put me in shape for this. But I didn't really get a conversation about this topic. And unfortunately, what's part of the problem is it took me a search into quantitative finance very deeply to find this answer or this topic. So, and the good news is, guys, today we're not going to teach you any statistics. I'm not going to require you to remember any tail T statistics or any of that fun stuff. It can be fun. No, not really. What we're talking about today is just the concepts, so you can use them even if you're not actually going to reduce it to quantitative. Now, it does have quantitative roots, and if you really wanted to get hardcore about it, you absolutely could, but that's not what we're doing today. We're just going to talk about the mindset, and so you can just do it kind of in your kind of a rough guess is what we're trying to do. And so prime example for us currently, when we're seeing it unfold. A good friend of mine was really, really excited about multifamily in 2018 and kept getting outbid, really like bid after bid after bid, LOI after LOI, and kept getting outbid. I mean, literally sometimes up to 20 LOIs per deal. And so you have to ask your question now, is that a good thing when you get outbid by 20 people? It's a good sign that there's activity, but at some point, and this is the question I posed to you guys, when was the risk asymmetry? When did it shift? Like, so for multifamily, 2010 was an excellent time. I kick myself for not knowing and learning about syndication in 2010, because the folks that got into multifamily in 2010 surely had an incredible run. Same thing with 2015. All the way up to 2015, your risk was probably very, very skewed on the upside. And so the question is, when did it shift to being more at best an even bet? And as we're seeing, when you factor in the bridge debt, the folks that took bridge debt in 2020 or 2021 with no rate cap are in a lot of trouble right now. So in multifamily, we're seeing a lot of distress, and I think that this is a kind of along the lines of the risk reward analysis. They didn't hedge their bet essentially. And Peggy, you have a point?
If you would take a minute, I just said letter of intent is an LOI. For some people that don't understand our lexicon, could you say what a bridge loan is?
Sure. In the bridge debt, essentially, there are several types of funding in multifamily. There are fixed products like from Fannie and Freddie that are more long-term, more fixed. Bridge debt is usually a three-year loan with 2 1-year options is a really common bridge loan. And what the bridge loan does is it gets you across the bridge, so to speak, from a certain pro forma to executing your turnaround plan, whatever that is, and then exiting, hopefully, ideally for a lot of profit. Now, what you should have done at that point, though, is getting a rate cap to hedge your rate risk. And this is part of the problem that's playing out is the rates were really, really low for a really long time. And everybody's like, okay, this is just a new normal. And even me, I was really fascinated by it. Why are rates this low for this long? And frankly, what it took is a pandemic and then a war in Ukraine. Those two factors are the driving factors. What really the supply chain disruption is why we're facing inflation for the most part. And a lot of people want to blame it all on the Fed and all the money from the pandemic. I'm not entirely for sure, convinced that it's just that. I think the supply chain disruption is a much bigger factor. And of course, the oil prices and the supply chain disruption across the board. Again, we can go down on the rabbit hole on that one. That's probably a whole other presentation by itself there, Peggy, but we won't go too far in the weeds. But just bottom line, we're trying to talk about what constitutes an asymmetric bet. And so wanted to talk about the sources of risk in real estate so you can kind of have a checklist for you and talk about what they are, like market risk. This is where you talk about things like interest rates, where you think about supply and demand factors, demand for your product. Like, for example, and this is the strange thing about the current problems in multifamily. I'm actually very bullish in the long run on multifamily because the demographics and the supply constraint of what happened after 2008 in the GFC. A lot of real estate developers, especially tract developers, got crushed in 2008. And so as a consequence, the single family production and the production of housing was basically obliterated. And so it took us literally, at least 6 years before the housing started to come back online. The problem is a lot of people that were crushed in 2008 did not come back. So we are literally, the estimates vary, but it's somewhere on the order of 5 million units shy right now. And so the problem is, and this is also a factor of the inflation problem, we don't have entitlement reform. And when I mean entitlement reform in this context, I'm talking about certain states, it takes 2 to 3 years to get a project from conception to delivery. And so that's a huge problem in some of the jurisdictions in terms of getting product to the market. So that's where market risk and where I'm talking about market risk comes into play. Property specific risk is talking about the location, the replacement cost, the tenant quality, is it what class, ABC, different aspects of the individual property that come into play. And then the financing risk. This goes back to the problem in multifamily right now. There are bad capital stacks across the board right now. There are a ton of bad capital stacks. notwithstanding the great demographics, right? So the distress we're seeing in multifamily is mainly a capital distress and not a economic distress. It's very interesting posture right now. And so, and of course, this is back again too, where the interest rate risk really caught a lot of people flat-footed. And you know, but for the grace of God go I'd love to say, and it's easy to say, you know, because I'm armchair over here. Oh, well, you guys were dumb. You didn't have a rate cap. I mean, I can see it. I can see we're like, oh, rates are good. I can see being lulled into that sense of security. So I think the lesson we're seeing here is, and I'm taking it very much to heart, do not fail to hedge your risk. And that's where the rate caps come into play. And then of course, there's the environmental risk, different contamination. And this is why the phase one is so important in your due diligence. Of course, the legal risk, if there's a zoning problem or there's a problem in the chain of title, this is where that kind of risk comes into play. So as you can see here, guys, these are like due diligence and risk go hand in hand. And that's why I think this is a great list that we should talk about. The one that sometimes we don't talk about enough is maybe the most important. And this is two most important factors. You and the operator. So if you're the operator or you're looking at a passive investment, this is where the operator is probably more important than I think maybe in the entire list. And I think the longer I'm in commercial real estate, the more it seems to me the operator is absolutely maybe the biggest factor in the team operating the property. So this is where Peggy does such a great job of getting to know the sponsors that she works with, getting to know them and say, okay, yeah, these guys have a great track record. This is why we should work with them. And then also, I'm sure she's had some that are like, oh, I don't know that I'm comfortable with those guys. We're going to pass on working with them. So, and I'm sure if you get out of school, she can share some stories with you on that. But this is another fantastic thing that I found along the way that does a great job giving a kind of a large overview of all your entire portfolio. It's like the periodic table of asset classes, and it's also structured by risk. So you can go, say, for example, collectibles all the way through classic cars, private equity all the way from a real estate fund, which is on the lower end of risk, where you can go all the way out to mezzanine and stuff like that. So, for example, currently in real estate, they rank industrial and residential lower risk, and then they go all the way out to raw land. And so that makes a lot of sense. A raw land investment is very risky through the entitlement process. What happens if you buy the raw land and then the city says, we really don't like your idea. We're never, ever going to entitle this. And so that's where it's like, okay, that deal didn't work out very good. So that's why raw land is viewed as much more risky. And then, of course, all the way from fixed income. So this is a great chart for your overall portfolio. I know I'm probably heavily biased toward real estate. I really just love the idea of being more in control with our outcomes. But of course, it's good to have other things in your portfolio. So this is a great starting point to start considering, okay, how risky is that compared to my entire portfolio? And consider this idea too. You might want to balance your portfolio with some risky investment, and again, also I want to suggest too that where you are in your investment career and how close you are to retirement, if you were in your 20s, you could justify going all development, for example, if you wanted. Let's load up on development deals and let's go swing for the fences. Where if you're close to retirement, you may want to get more defensive in buying real estate debt, for example. And so that's a part of the discussion too that you really want to think about in terms of, well, when I'm allocating money, how close to the retirement am I, and how close do I want, how defensive I want to be in my portfolio? That's another great discussion around this. For example, for our firm, we love the idea of being the bank and putting debt in your IRA and your self-directed IRA in your 401k. We really love solo and self-directed retirement funds. So we really love being the bank, and we've created a debt fund to do so. And kind of on the opposite side of the risk spectrum, we love build to rent. We think the supply constraint is savagely unhealthy, and it creates, again, another asymmetric upside. And that's why we love being the bank. If you get a high interest loan, but it's collateralized by real estate, we feel like that skews the risk to way more upside versus the downside protection of having the collateral. So that's why we like those two investments very much. And then getting toward the end of the presentation, guys, I do have, if you really, really love this kind of stuff and you want to go down the rabbit hole as I am wont to do, a couple recommendations. Probably the best, easiest way to start this investigation. They're kind of ranked from easier to harder, I guess. In a way, I definitely recommend the Nassim Taleb. He does a fantastic job in a series of books to really get in your mindset. I could say he probably really was the first one to really change my mind about, oh, okay, I see I'm not thinking the correct way about risk sometimes, and really help you think differently about risk. Also cannot recommend When Genius Failed Higher. It is an incredible discussion, and the beauty of this is don't fool yourself is essentially the thesis of this book. Literally had a hedge fund with like Nobel Prize winning finance people, and they managed to blow up a hedge fund. And it's like it like sends a chill down your spine. It's like the smartest guys that literally ever lived in finance can blow up a hedge fund. Guess what? With my mediocre IQ, I could easily really make a same mistake, and also don't try to fool yourself too much. I guess is don't get too cute, I guess is the thesis. And then another one I recommend, and it's not as much about risk as much, but it does definitely give you a psychology issue, and a deep dive into that is The Psychology of Money. Against the Gods is really a very, if you feel like getting a little geeky and understanding the statistics and how it's progressed in throughout times in finance and making investments. Another one I didn't put on here is Thinking in Bets by Annie Duke. It's not on this list. I should have. That's a huge omission. And then a bonus one, Hedgehogs. Is about the Enron and how the traders again they got too cute by half, right? And so it's another great example of how not to think about this stuff and how to blow things up. And guys, I had a little bit of time this afternoon. I'm like, oh, I completely forgot about this one. This next topic is extra geeky, so you may not ever really want to go down this rabbit hole, but I did want to throw it out there in case we wanted to go here. And talk about the Kelly criterion. And what the Kelly criterion is a way of thinking about what is my optimal bet. And so what you're trying to do is think about the optimal growth and the optimal risk given the probabilities. And so it's basically, what is my expected value and how is that going to work out? And to just give you the overall graph, essentially what you're trying to do is get to this point of the graph where you're taking, risk reward. This is again like the optimal risk reward where your upside is good, but your downside's not horrible. So essentially, you want to make sure, and again, it's also about allocation. Also, you don't want to put like if you got a good bet, but you put too much leverage on it, for example. And this also kind of gets to the point of leverage. Also, if you have too much leverage, that can also take you out of the range and can get you into a point where you're not going to have a good outcome. So this is just a broad overview that I want to introduce the Kelly criteria to you guys. This one is definitely might be a little bit more statistical and where you might want to really get into the weeds about the statistical side of things, but that's definitely a place to look. And that's basically all I had for today. And I'm open for questions.
Well, good. I love that it became suicidal.
That's right. And
how do you know that? I mean, how are you going to look at something like that to see that it would go? I mean, that kind of brings up what that conversation was this morning with Ethan.
Yeah.
Is when somebody There's a difference between somebody backing out of a deal. Why are they backing out? Than somebody that didn't put their deal together properly.
Yeah.
Somebody that didn't put their deal together properly, that ends up suicidal, doesn't it?
Yeah, it really does, and it gets to the is a developer who finances with 90% debt more. That's almost, to me, kind of like, historically we know that the development deals that are highly leveraged can be real trouble because there's so many variables from starting to finish. Whereas Gerald Heinz, I don't know if you guys know who Gerald Heinz is. Built one of the started in like 1950 developing in Houston, if that gives you an idea what kind of run he went on. And he never lost a deal as a developer. And the main reason why he didn't, he kept a very conservative debt ratio. Literally, they would never finance over 50%. It was always 50% equity, 50% debt. And if you're a developer, I'm not saying that's necessarily the way to go, but if you want to think about longevity and long term, managing your debt conservative like that is a source of risk also. And that's part of the discussion that should be added in here too, is the amount of leverage that you pile on can be a huge factor in the risk you're taking.
What do you consider long term?
That's a good question. I think it has to be relative to the certainty. So like a multifamily building, for example, if you know, like you're already getting, it's 95% occupied. It's in great physical shape. You can probably afford to put 85 to 90% leverage on something like that. Possibly, you may want to go that high, but that's an 80% loan to value there is not very crazy risky, right? But if you've got a empty apartment building and putting on 80% leverage, that's you're asking for trouble in that case, because how do you know you're going to succeed in executing your plan, for example?
Yeah, but the length of time, like isn't there a reason they give you a 25-year loan? Don't you want to have that paid off in 25 years? So the part that just boggles my mind, having come from a different generation of investing, is if you bought a 100-unit apartment building and you had a 25-year loan on it, in 25 years, you have a free and clear property. I get, you don't have the cash, but you have the cash flow, which is built up over the years. And you don't have to go out and find another property. You keep your reserves growing. So when you need to fix up and make the property look nicer, so you're never an add value property because you always added your value, why would you crazily sell something in 5 years and think you could find another good deal? I don't know. It's beyond all the effort I ever wanted to make. I'm not getting that part.
Yeah.
So that's why I'm asking what long term is, because I think long term as the length of the loan and longer. Like I know families that never ever sell anything. And then all these people we talked to over the last 3 or 5 years are like, oh, we're going to fix that up and sell it in 3 to 5 years. That's long term.
You make a really great point too, Peggy. The situation you are in as a syndicator motivates you versus the LPs. The LPs probably limited partners probably are in a better position to hold on and wait longer, where you as the sponsor, your waterfall motivates you to sell, like to repeat that over and over again. So where you're standing in that conversation, your interest, and it's an interesting point too. You do see families that have built real estate empires that have zero outside capital. And often what they did is they had a property that increases in value over 5 years, refinance, use that money to buy additional properties. And you do that over a 10, 20-year period, you could amass a pretty sizable portfolio that way.
Absolutely. And then you don't have any LP. Well, you have the family, but that's the whole idea.
That's it.
Take care of the family, but yeah.
That's right. And
they're not LPs anyway. They're part of the trust.
That's right. Cliff, you got a question?
Yeah, Cliff.
Yeah, I was just wanting to comment on that and a couple of things. So I think a lot of syndicators out there, instead of holding long term, they find more of a benefit in buying, doing whatever value add or momentum play even, and then selling that because there's more money with the upside. And a lot of the syndicators, they provide such, in my opinion, paltry returns between 6 and 9%, that in order to really give their investors what they want, they have to actually provide that upside at disposition. The challenge I believe we may actually see in the near future is based on what Douglas was saying earlier. I think that, if they have the refi as part of their strategy, they're going to be caught by the short and curlies, because the interest rates are going to go up. They're going to get stuck. They're not going to be able to refi and cash out like they originally thought. And they won't be able to provide the returns back to their investors. So they still have the 6 to 8%. And then I think a lot of the multifamily I see today is more midterm. It goes 7 years and that's about it. So it almost seems like anything long-term is 8 years or more, because you really don't see that as much anymore. But those are just my opinions on that. And then kind of jumping back to something I heard earlier, inflation was definitely going up before we had the war in Ukraine. We already had a CPI of 7% in December before the war on Ukraine actually started. Back in 2013, the Fed started purchasing mortgage-backed securities. We had a very slow housing market. Interest rates were still, not high, but they were moderate. People really weren't moving back in the housing market and buying again. And the Fed started purchasing mortgage-backed securities, and they actually claimed that it was in an effort to, keep bond rates stable and improve liquidity. But I believe it really was to bring interest rates down on mortgages. And then when you got to January of 2022, they started selling off a fair amount of mortgage-backed securities. And in March of 2022, they announced that they were going to stop purchasing mortgage-backed securities. As a matter of fact, they started selling about $45 billion worth of mortgage-backed securities per month. And that correlates very well with the spike we saw in interest rates at the same time. And if you look at September of 2022, they upped that from $45 billion per month in selling to $95 billion per month in selling. We saw another spike in interest rates again. So there's a hidden game that the Fed has been playing with us that most of us have not been looking at, because most of us are trained to look at the 10-year Treasury bond yield, for rates. And when you have manipulation behind the scenes with the mortgage-backed securities, it kind of changes the rules a bit.
I don't think there are rules. I think they just make it up as they go.
Well, when I say rules, I mean loosely for how us as investors are trained to actually look at rates.
Thank you, Cliff.
And that's it.
Ivan, what you got for us?
It ties perfectly into what Cliff just mentioned. And I got to give context because I am technically a sponsor. So what ROI, Douglas, would you find out or find to be a red flag or a no-no? Like, don't say anywhere near these numbers. And I'm asking this because my fund is more inherently higher because it's higher risk, higher return targets. So what, just also for my help to assist in my advertising, what would be a no-no? And
I don't think there's actually a no-no per se. What I would say is it justified for the like, for example, if someone came to you with a development deal, but the ROI, the IRR was going to be, for example, let's say 15, that is simply just not enough internal rate of return for a development deal. You need for a development deal, for example, you need to see 20, 25 easily, right? So it's relative to the asset class and what you're doing. And so the business plan is very stabilized apartment, then you can justify like a 15 or something like that, or the 12. The lower IRRs make more sense on a stabilized deal. So it is relative to what the asset class and the amount of risk that someone's taking on. So for me, there is no good or bad necessarily. It's just relative to what they're trying to accomplish. Is that a justifiable bet or justifiable gamble? And are you being compensated? So for example, like I'm saying, you come to me with a development deal and I'm getting an IRR of 10, I'm going to be like, you guys need to stop what you're doing and go do something else on this project, because this isn't going to get it.
And what I would say on that is you need to show how you're mitigating the risk. Okay, this is high risk. What makes it high? And as whatever that is that makes it high, on the other end, how are you mitigating that? If I don't know if you saw Douglas's chart, would you call it, that showed the upside is big and the risk is low. But what it sounds like to me, what you're saying is the upside is not very high and the risk is very big.
Yeah.
So so for people like us who vet out your deal and look it over to make sure it meets our investors' demand, we want to see how are you mitigating that risk. We have to be able to say to our investors, look, this is how they're mitigating the risk. Yes, it's risky, but this is what they're doing to mitigate that, so that you'll see that they're taking those things away so that it's not as risky. Yes, it's still risky because of whatever it is, if you get what I'm saying.
Yeah, that makes sense. I'm glad you mentioned that too. The situation, by the way, was just one investor that was interested that just said 15 to 20% sounds too good to be true. And they just kind of left there.
Oh, wrong investor. Anybody who's looking at 15 to 20%, that's who would want to look at anything less.
Right.
But see, I come from the generation of you bought an A-class property with an 8% cap rate, turnkey, did absolutely nothing and got an 8% cash flow. That's where I came from. When you were getting a 13 to 15, 18% return, that was a C-class property that needed work. And that's why you were getting the high returns. Now you're lucky if you see a 3, 4, or 5% return, and it could be an A-class, but it's crap. Like, you guys outbid each other. Like, that's how Doug started the conversation. Was his friend was making a letter of intent on a property, and 20 people came in and outbid each other. Well, that's called stupidity in my eyes. Why did those 15 people get together and collaborate and put a deal together that made sense? Because what they did is they hurt everybody that wanted to get into the business. They hurt them by doing a stupid thing like that. I'm sorry.
Peggy, I'm not blaming bigger pockets, but I'm not blaming bigger pockets for this.
Okay, well, part of it happened in the 2000 when all the people jumped out of the stock market and said, all I care about is that I break even, which is the absolute worst word you could say to real estate investors, because we never go into anything that breaks even. We want to see those double-digit returns. We want to go in at something like this 8 or 9% if it's an add value and turn it into a 12, 13% return. We don't break evens never on our radar. It's always make your profit going in. And I don't know who's out there teaching these days, telling people you can push appreciation. No, you cannot. You have to really add value to be able to raise your rent. So.
And Peggy, to your point, I think that's also a sort of source of distress, is the people that had these beautiful pro formas on a spreadsheet. And guess what? When we hit rocky times and things start to slowing down and the supply starts to catch up, that's where you can get into real trouble. Your pro forma was way I think Dallas has some of this going on. I'm certain Phoenix, some of the deals we were seeing come across the plate in Phoenix were just bananas, that we were like, what are you guys doing? $400,000 a door for multifamily. That just, I don't care if it's class A. I just couldn't make sense of that.
And now they're saying, oh, the market's soft. Oh, really?
You're kidding.
Cliff. And hey, anybody have any questions? Just raise your hand. If you don't know how to raise your hand, you go down to, there's something at the bottom. It's not participants, reactions. And there's a hand there you can raise. Thank you.
I think something else that's going to kind of surprise a lot of people in multifamily, and inflation, in my opinion, is a really big driver of that. And then you have interest rates, going up at the same time, which is really squeezing a lot of people. Typically whenever, times get a little challenging, people in A class, units move to B class moves to C class. But because inflation has hit so many families across America, 60% of America today is living paycheck to paycheck, literally. So they barely have enough money. If they miss one paycheck, they're in a lot of trouble. Something's not going to get paid. People are starting to make decisions whether or not to pay rent or buy medication. And, now that that's happening, people are going to start doubling up. People who are friends, people who know each other, they're going to start advertising and doubling up. And while supply is very low right now, when that starts happening, and don't think that it won't, because if you recall back in 1989 through 94, it happened. And there were a lot of concessions in the rental market. A lot of multifamily properties had free heat, free rent for the first month. free heat for the first 2 months. So they did a lot of concessions, just draw people because supply was so high because so many people had to double up because the economy was just that bad at that time. We're facing a period right now where people cannot afford to actually pay their bills because inflation has risen so much so fast. And then with interest rates rising, what they have on their credit cards is so high they can't pay them off today. So when that happens, it's going to catch a lot of the owners of these multifamily properties by surprise when they all of a sudden start having vacancies because people are starting to double up. So that's my 2 cents on that.
Can we write Congress and ask them to tell the credit card companies that they can't charge more than 3% until we get through this time?
I don't think that that's going to work.
Well, they're the ones that told them they could charge.
Nice.
Congress is the one that told them they could charge the 14 to 26%. So Congress is the one that can tell
Congress
them
should
that-
actually have some governors put on them where they can't actually continue to borrow as much as they're borrowing. And that'll help our inflation quite a bit. But not
tell
everybody
the
will do
people they
that.
can't borrow.
No, that Congress can't borrow as much money as they are borrowing. They
Oh,
can't
why don't
spend
we
as much
just-
money. It creates a massive deficit, which creates more inflation.
It is massive. Yep. Nathan, you have anything to say on this? You're a note buyer. How are you affected by what we've been talking today about the risk and the rewards and the
For
high
me,
risk?
bad news is good news for me. So I kind of sit back and listen to all these, bad things happening and hard things coming. And
That's opportunity for you, Nathan. Yeah, I mean, that's huge opportunity in your world.
It is. I started in notes in 2008 and I started buying non-performing in 2010 and it was a heyday. And I don't think we're going to see that again. I could be totally wrong. I don't know. But
Nate, I tend to agree with you. When you look at the amount of equity in most single family homes, it's ridiculously different this time with regard to how much equity in most houses have. So in worst case scenario, they just sell and move on down the road. I just completely agree.
the other thing that's a little bit different, well, that's quite different, is we had a couple of years there and a lot of people took advantage of really low rates. So they locked in at 3 or 4% with a whole bunch of equity. So for them, for things to go so badly that they're desperate or can't make their payments, something would have to go very, very wrong.
Mm-hmm. Okay. Ethan, I don't know if you're with us. What about you for risk? What you see, what we've been
Yeah,
talking about.
we need to lend people to really stupid people that don't have their shit together. This is how we make a lot of money.
Well, if they don't have their stuff together,
Yeah.
how do you actually make money on something like that? If we lend to because we're lending only on like real estate so that you get the real estate?
No, that was a joke. So no, we should not lend to dumb people who don't have their stuff together.
Well, what happens to those people that don't have their stuff together? Do they end up not being able to do a deal, or do they end up losing what they have?
Yeah, sometimes they lose the deal. Sometimes they find somebody stupider than them to lend them the money, or sometimes they just solve the problem somehow, like randomly. But I've seen people lose deals. I've seen people just like have their dad come in, or their dad and their mom, or their in-laws, or their brother, or their friend's brother. Like just random stuff will happen.
Okay. So hopefully you know that your family's doing a good job. And you asked the question. So really what Ethan just brought up is a really, really good point. A lot of families lend to family because they are family without doing their due diligence. And a lot of family members never get paid back. So if you have family and you've been asked, ask what the risks are and how they know they're going to be able to pay you back. And is it better to pass on the deal? The family member that's who's making the deal, is it better to pass on that or get them to pass on it than take the risk of losing not just the family's money, but also the relationship? Because they do have a tendency to separate family when you lose their money, especially when it was all they had. Just
I have a
a,
general rule. If I ever lend directly to family, it's not a loan, it's a gift. And then if I get it back, then that's not a return of payment, that's a blessing. So if I look at it just like that, I never stress about it. I never lose family members.
that's very nice. That's you're rare, but you're already a nice person. But it's
Are you
rare
taking
for-
applications for new family members? I'd like to apply.
You know, I said, if Ethan, if I lend money to a family member. So, you know, so even if you're a family member, I still might not lend it to you.
Okay, so the dumber parts of your family are not gonna lend to.
Sorry, it doesn't fit into that category. Does anybody have any other questions? You're here, Barbara. Are you online with what was spoken about? Do you have any questions? Is there anything you didn't understand? All right, you're good. That's good. Well,
I could add something to that last story if that's okay.
Sure.
I actually heard a nightmare story regarding that same scenario. A family member invested like all their savings with a family member, and then a year later they found out the property turned out to just be a vacant lot when they drove by it. So just having unconditional trust is a massive conflict of interest risk situation. So yeah, hope none of you go through that. So
Yeah, I mean, that was a big thing in Florida. There was a bunch of deals like that. In fact, it happened a couple times in Florida. 1930s, that was a big part of arguably part of the banking crisis that led to the Depression. Honestly, there's an argument out there for that. Happened again in the GFC, where that kind of stuff happens, where they're fraudulently creating parcels that don't exist or buildings that don't exist to get the loan, and so again, the due diligence process. And we are remiss not talking about the 3,200 unit foreclosure. That's a fascinating case study right now in risk. And frankly, this is for bankers. You should be like having night sweats after this story, because it's like, why did the bank at the end of the day, is bearing a lot of risk here too. So you're asking a lot of questions right now. At least I am. Who's the loan officer that originated this? I want to know where I can file an application with them if they're going to just lend 3,200 units like that.
You and Ethan will be standing.
Yes, we'll go see them together, I think.
Oh yeah. And then nobody bid on that one, right?
I think from what I heard, again, I'm hearing all kinds of partial truth, misinformation, and all kinds of things. What I do know for what I've heard is that that a arm of Arbor rebought it to turn around and sell it to somebody else and give them a loan. So from what I understand, that they REO'd it and then completely and turned around and sold it, from what I heard. But I don't know if that's true.
Well, it'll be public record, so
someday soon we'll know.
Yeah, someday soon we'll know, because whoever came in probably paid cash for it.
Mm-hmm.
I know when I was talking to family offices a couple years ago, they said, we're just waiting. We're just waiting. Because they knew it was coming. And I don't know. Some people just don't listen when you tell them, look, the rates aren't going to stay where they are. You've got to be cautious about that. No, we'll be fine. Just like what you talked about, the loans.
Well, and again, Peggy, the takeaway for me is always be hedging. How can you hedge your risk? There are ways to do that. I think that's the great question, is how do I hedge my risk here? And if you can't find a way, then you have to bear it. And you have to be really, really comfortable with that naked play if you're going to take it.
Yep. I have one more question. It was on your presentation, and I because I didn't get to read all of it, but you were talking about build to rent, and there are constraints, and I wondered what the constraints are.
This is referring back to the overall supply constraint of all those developers that got crushed in 2008 that didn't come back, and so we have so many such a deficit in housing units that it literally is 5 million or so short. I don't know if. And really the caveat there is household formation. So that's a real good question too. But no matter how you look at it, we are way short in the number of housing units we need. So we just need more product to help alleviate the the rent crisis.
But don't we need more developers too?
We do. In fact, you're talking to my heart and soul more than ever. Being in the House of Representatives, which is a nightmare to me at this point, by the way, Peggy. Developer, build baby build is all I can say. Just we need more developers. We need more people willing to get in there and fight the good fight.
I've got 80 acres in Iowa. And I have called around the country to a few people in Iowa, and they're all no. And I've talked to some build to rent developers, and they're a no. And I don't know. It must be Iowa. Iowa is doing things to bring more people in. Like wouldn't we love to have this in California? They've taken the income tax down to 3% of your, I don't know how that works exactly, gross or net income, whatever it turns out to be, because they want to bring people in. That's what the governor did. Anyway, I know you like to work in that arena. Got 80 acres in Iowa. If you know anybody that wants to build, and the utilities are right there to it, and there's water. They put water in a big tank or whatever you do to dig out water, gravel road. Just things that will make it easier for a developer, and they can also cut down the trees and sell the trees, or have a tree company come in and cut and make money on that. So it would be helpful, and it's right next to another development. So it's not like there's nothing going on.
Where is it in Iowa?
It's in DeWitt, which I'm sorry, I don't know what county that is, but it's a small, it's only 3,500 people, but it's in a radius of like 45 to 50,000 people, because it's close to 6 towns. People just drive. I mean, we're LA 647 miles, not square at all. And it's not like that. It's like you go 6 miles, you're in another town. You go 6 miles another way, you're in another town, et cetera, et cetera. And there's a community college, and it's just, it's different than how like LA is. And the next town over is where I am. I'm in a small town. We're like, can't remember, 3 square miles. No, it's unsquare. We're at the foothills. But the town next to us is Pasadena. The town on the other side of us, which is 2 miles away, is Arcadia and Monrovia. And so
DeWitt, by the way, is approximately 30 miles or so west of Clinton, Iowa, and about the same distance north of Davenport, which is Quad Cities.
Yeah, so there's population around there, and they have a need also. That's my pitch on that. I'm just helping one of our clients.
Question that I ask developers in some places: if you're going to build residential housing, where do you expect the people who occupy those residents to work?
Yeah, well, there's a hospital, and there's community college. Yes, Cliff.
I was definitely agreeing with Ted on that. I mean, I think a lot of people, they definitely need to consider where the jobs are coming from and what type of jobs are in the area, and are there any new job announcements?
Yeah, that's why you call the economic department first to say, what are you doing to bring in new companies, and what's the pay level of those companies? And oh, by the way, how many companies are shutting down and leaving? That was always my first call before I invested in any town that I didn't know.
Yeah, your economic development committee, find out, what their plans are, where they're expanding out to. Chamber of Commerce also, but economic development committee, if they have that, is probably the best starting point, Peggy. That's right.
Right. Hey,
the fun question that goes along with this is, how do you create a ghost town?
Kill all the jobs.
Right. We have Tony
What kind of jobs do you kill?
You kill the highest paying jobs.
Okay.
I would suggest that the way to create a ghost town is to kill off the companies that buy from friends and sell to strangers.
Why would you
Because-
even bring that up, Ted?
That's interesting.
We like to stay in
because-
a positive conversation.
Okay, because the point is, the other side of it is, how do you create a prosperous community? It's easier to see the negative side first. And then you say, okay, how do we avoid the negative? So the idea is, if we want to have a prosperous community, the focus should be on encouraging what I call producer businesses in the area, because those are the ones that bring money into an area. If you bring money into an area, then everything else will survive. I mean, we'll have an opportunity to thrive. If you drive the producers away, as Illinois is doing at the moment, then everything just spirals down and down and down and down and down. When you see the big boxes closing, they're telling us that they've taken all the money they can out of this community, and so they're going. And that's probably the canary in the coal mine, so to speak. You know,
Okay, thank you.
retail
So,
can't survive unless there is a strong producer community bringing money in.
Thanks,
so
Ted.
we have Tony Davis, who drives through Iowa every day that he drives for FedEx. So Tony,
I just want to say I live in the Quad City area, and there's a ton of high-paying jobs. It's like the John Deere capital of the world, and there's a lot of companies that support John Deere. There's 2 power plants. There's 3 hospitals. There's several community colleges. There is a ton of money in the Quad City, so there's plenty of income in that area. So that's all I wanted to say. There's a lot of high-paying jobs in the Quad Cities area. And there's a lot of development too. There's a lot of houses being built on the Iowa side.
And what's the Quad City area? I think I missed that.
It's Davenport, Bettendorf, Iowa, Moline, and Rock Island, Illinois, and then a bunch of smaller communities within a 30-mile radius. It's probably about 300,000 people total. You combine everybody together. But it's a lot of good industry in the Quad Cities.
oh, thank you. That's good to know.
My 2 cents. I just went with my 2 cents. And
We
Guys like Tony are people we need to know
yep, exactly. And guess
about
what?
a geographical area.
And guess what? We know Tony. So there you go.
Yeah.
And they're you guys are still flipping, right?
No, we are buying and selling.
Okay. Good for you. Anything else you want to add? Because I think this is like the second time you've contributed since you've been coming on for 2 years.
But I like to keep quiet. Well, I do contribute when you're not here, because you
Wow.
scared me, I guess. but no, I'm just saying there's a lot of industry in the Quad Cities area. That's all I'm going to say. I mean, there's a lot of stuff going on.
Thank you.
Well, Tony, you can contribute anytime, regardless of whether Peggy is here or not.
Yes, please
Yeah.
do. Thank you.
I'll keep that in mind.
Okay, thank you.
Thanks, Tony.
We're excited when you're here, Tony. You know I love you coming on our
Is
show.
that why you didn't invite me? Because I never got an invite.
Oh, no.
Did it?
It was
Yeah,
definitely an oversight.
When I filled out my thing from last week's meeting, they asked who invited you. I put nobody. So
Okay.
nobody invited me.
Well, you have an open invitation from me personally.
Okay,
Okay.
it's all good.
Well, and we'll double check into that invite. Thank you.
Okay.
Well,
Okay,
I originally invited you, and then you're
then you just cut out.
supposed to
Meet
just
your
put it on your
friends.
calendar forever.
That's right. So now you know that you've got 2 people that have invited you. Nika was the first, and you should get your wife to come on sometime. Okay,
I don't know. She's not really into the whole listening to this kind of stuff. She lets me tell her. It could be something to talk to her about.
Oh, okay. All right. Oh,
Well, we better move on to Fred. We're getting close to the top of the hour.
we are. So Fred,
Fred, you're up.
Hey, thank you. I've enjoyed this whole hour because I think a lot about risk when I'm looking at different deals. And Peggy's nodding her head because she knows I'm a nerd. But I have a question for the group and for Douglas, since he's an expert on risk. I don't know if he's still on, but I'd like to hear people's opinions about multifamily housing and Section 8 housing, which is not something I know much about. I'm learning about it, but if there's any specific thoughts or risks that people think about or know about with Section 8 housing, I would love to hear about them.
I think my take on that is it can be great depending on your going in basis, how much you're having to pay for the right. I think there is a lot of nice aspects of Section 8 in that it's a government guarantee. So if you have the operational shops to deal with it's a different animal. And I would have to think if you're aware of that and understand the operational differences, then it can be a great business also.
Angel just said her grandparents had Section 8 residence and loved it. And I've talked to two different multifamily sponsors who are both going into Section 8. And the reason they're going in is because it's guaranteed. And I always ask them, are you going to make sure that the tenant pays their share, their rent? And they say, absolutely. Because if they don't, it causes a lot of problems, because word always gets around when rents are being raised or people are not paying rent or whatever. It gets around the community too quickly and changes the entire community. So you have to be really careful about that. But it's guaranteed. You just have to deal with whatever it is that the Section 8, why are the Section 8 people there, and give the support that they need, the community center and doing the pizza nights and doing things to make it a nice community center. And keep
and Section 8's good. I mean, they have to qualify for the vouchers they receive, and they don't want to do anything that would disqualify them from receiving the voucher. So, no crime activity, no criminal records. They live a normal, decent life. And, Section 8 in a community can operate just like any other tenant. And most tenants would have no idea that Section 8 is even in the community. And, a lot of communities are, as rents are raising, the government is providing increases to those vouchers to accommodate changes in rents. So don't think that because it's Section 8 you can't raise rents. You still can, within reason, but it can be very good income and it's guaranteed.
I'll also add to this because sorry, Peggy.
No, that's okay, Vlad. Go ahead.
I was just going to add to this because my fund is also affordable housing focused, and the thing to keep in mind if you're doing like sort of my strategy, class C and D, kind of a value add heavy renovations, it might be more cumbersome because I'll give you an example. There's a duplex that was built in the 60s that we own in our portfolio, and the Atlanta Housing Voucher Program that works through Section 8, they made a 20-item checklist for us, but we could just rent it to the public at an affordable rate, naturally affordable, without having to do the checklist items. So it was a fast turnover without the government involvement. So that's something to keep in mind too, government bureaucracy. If it's a newer property, you might have the same issues because it doesn't require a checklist.
Thank you very much, Yvonne.
That was one thing I wondered with Section 8 projects is the value added strategy as effective? Because if you put money into the property to improve things or to make it, to build loyalty with the tenants or whatever, are you going to be able to recoup that through the rents over time? Or is the government not going to allow rents to be raised sufficiently for you to recoup those extra costs that you might spend to make the property better?
I think you can.
They pay better than.
Yeah, like Peggy was saying, you can, but there are like maximum caps per area too.
Right.
Okay.
So you might look into it specifically for what you're looking at. So let me
And you're-
close this out, Fred, and then we'll get your
Okay.
last question.
Okay.
So thank you everyone for coming. It's the top, past the top of the hour. Douglas did a great job and I do believe he's left, but we sure would like to have him back, but he sure has stimulating conversations and great topics. So thank you, thank you, thank you. We'll see you all next week.